Have you ever seen a hot new company go public and just wondered, what's really going on behind all the hype? Well, today we're going to pull back that exact curtain. We're dissecting the one document that tells the entire story, the S-1 filing. And we'll be using the insurance tech company Ethos as our guide. Let's get into it.
So before we even get to page 1, the document hits you with this massive warning. This is the government, in big, bold letters, basically shouting that just because this document exists, it is absolutely not an endorsement. It's their way of saying, hey, we didn't check their math, you're on your own here.
And, in that same spirit, here's our own quick disclaimer. This whole explainer is for educational purposes only. We're here to learn how to tear these documents apart and understand them, not to give out any kind of investment advice, okay? Okay.
So what exactly is an S-1? Think of it as the official, mandatory paperwork a company has to file with the SEC before it can sell stock to the public. It's basically the company's entire autobiography, its business model, its financials, and, most importantly, a super long list of everything that could possibly go wrong. It's the ultimate source of truth.
All right, here's our game plan. We'll start with the blueprint of the IPO itself, then check out the story Ethos wants to tell. After that, we'll decode the deal, comb through the official risk list, and finally, see what this thing truly reveals when you put all the pieces together.
So every S-1 kicks off with the sales pitch. This is where the company gets to paint this grand vision, in their own words, to get potential investors really excited about what's coming next. Let's see how Ethos tells its story.
And boom, here it is, right from the founder's letter. You see, they're not just selling insurance, they're on a mission. The keywords here are democratizing access and empowering agents. This language is designed to frame them as a modern, tech-savvy disruptor in what's, a pretty old-school industry.
So how are they going to do it? Well, they call their business a three-sided technology platform. For you, the consumer, they promise a super easy digital experience. For insurance agents, they're offering tools to make their jobs way easier. And for the giant insurance carriers, they're basically a pipeline for new customers and growth. Ethos puts itself right in the middle of this whole ecosystem.
All right, so that's the story they're selling. It sounds pretty good, right? But an IPO is a financial deal at its core, so now let's switch gears and start decoding the actual mechanics of what's being offered, the nuts and bolts.
Okay, now what's really interesting here is the breakdown. You see, they're offering about 10.5 million shares, but look closer. A little less than half of those are brand new shares being sold by Ethos to raise cash for the company. The other half, actually a little more, are being sold by existing stockholders. Think early investors, founders, insiders. Basically, they're cashing out.
This next part is absolutely critical. You have to understand this. Not all stock is created equal. The Class A shares they're selling to you and me, the public, they get 1 vote per share. But the Class B shares, the ones held by founders and early investors, they get 20 votes per share. This is called a dual-class structure, and it has massive implications for who's actually in control.
And this chart just lays it all out, plain and simple. After the IPO, all of us public shareholders combined will have less than 5% of the total voting power. The co-founders and their big-name venture capital backers, they'll control everything else. The takeaway is crystal clear. Public investors are providing the money, but they're going to have almost no say in how the companies actually run. One more key definition you'll see in these filings. Ethos calls itself an emerging growth company. This is a legal status that lets smaller public companies get away with fewer disclosure rules, things like providing less financial data or details on what they pay their execs. Ethos is choosing to use these exemptions, which means investors are getting less information than they would from a bigger, more established public company.
And now, my favorite part of any S-1, the risk factors. After pages and pages of optimistic hype, the company is legally required to list every single thing they can think of that could completely tank their business. This section can be dozens of pages long, and it's where the real juice is often hiding.
Let's start with the big ones. The company flat out admits it has a history of losing money and warns that its recent profitability might not stick around. They also point out that legal battles are a constant risk, and that even after going public, there's no guarantee the stock will hold its value. These are pretty standard warnings, but they are incredibly important. Being in insurance and tech puts them right in the middle of this crazy web of rules. They're handling super sensitive health and financial data, so privacy laws are a huge deal. They also highlight risks from marketing rules, things like telemarketing and anti-spam laws, and even anti-money laundering regulations. One tiny misstep in any of these areas could be unbelievably expensive.
Now, digging deeper into their tech, the S1 reveals some pretty interesting vulnerabilities. For one, they don't have patents on their tech. They're just hoping to keep it a secret. But more surprisingly, and get this, they don't even own a U.S. federal trademark for their own brand name Ethos. They also admit that sharing customer leads with third parties opens them up to major privacy risks.
Okay, we've heard the optimistic pitch, and we've read the laundry list of warnings. Now let's put it all together and see what the hard numbers buried in this filing actually reveal about the business itself.
First up, let's look at the top line. In the last 12 months, the company pulled in an impressive $320 million in revenue. That shows they have some serious traction in the market. But is it growing?
Oh yeah, it is. That revenue is growing at a blistering 57% year over year. I mean, that's the kind of insane growth that gets investors really excited. But as we all know, growth like that often costs a ton of money. So, are they actually profitable?
And here is the kicker. The answer is yes. Unlike so many high-growth tech companies that are just burning through cash, Ethos actually posted $61 million in net income. They're not just growing fast, they're doing it profitably. That's a huge deal.
And this didn't just happen overnight. This timeline shows a really clear, deliberate progression. They started with one product, then they expanded their offerings, opened up new sales channels. And then in 2023, they hit that crucial milestone of profitability, all while still innovating with new products.
So what does this all mean? The S1 doesn't tell one simple story. It tells two, right next to each other. On one hand, you have this incredibly exciting story of a fast-growing, profitable tech company. But on the other hand, you have the sober reality of a business that's in a highly regulated industry facing a total minefield of risks. The real story of Ethos lies right there, in the tension between these two narratives.
And that really brings us to the final thought. The S1 gives you the full context, the kind of stuff you will never ever get from a flashy news headline. It gives you the best case scenario and the worst case scenario, all written by the company itself. So the real question is, now that you know how to find both sides of the story, how does it change the way you look at the next big IPO?